I think that's absolutely right. I think emerging markets are facing multiple shocks, not just the COVID-19 shock that you mentioned, the political ramifications of that, but also the big commodity price shocks that have taken place in the background. And I think that is a big hit to emerging markets. Many of them are undiversified commodity producers. Latin America is specifically vulnerable to that. So I think, investor appetite is low, and definitely you saw a big withdrawal in investor flows back in March and April when the crisis was at its height. What is, however, striking is that when you look, for example, at the hard currency debt issuance across emerging markets, certainly for the EM investment grade sovereigns, you actually had a very strong April, and the year-to-date issuance from investment grade emerging market sovereigns is equal to what you saw through all of 2019 altogether. So yes, very challenging period for emerging markets, but at least for the higher quality sovereigns, there is still a market where they're able to issue and place their paper.
Kamakshya, very good to hear from you today. You've got me reminiscing back to the bad old days of doom loops in the GFC, because I'm looking at your who will take the other side of the trade copy, and I was looking at the first, the second and the final line of defence. You've got me really worried, sir, at the losses that the pension funds are going to incur, the losses that the local banks are going to incur, and the doom loop that the sovereign is going to have when the governments themselves buy their own paper as well. I should be worried, shouldn't I?
I think you should be worried about some places. I think that what we try to show is that there is a wide range of emerging markets out there. And for some, the depth of their pension funds, insurance companies, the deep local markets means that, yes, there will be a significant deterioration on the fiscal side. Yes, there will be significant issuance, but there is also deep financial markets on the other side that can absorb that issuance without that having a big impact on the prices. For countries that don't have those deep pension markets, it's a harder challenge, because there either the commercial banks will have to end up being more elastic and buy more of that, absorb more of that government issuance, or in the worst case, it'll have to be central banks doing some of that. Now we know with in emerging markets in particular that has an unfortunate history when central banks buy a lot of their own government paper, and when there are no other either foreign or domestic outside buyers or sort of price sensitive buyers, that can lead to a slippery slope to monetization and other problems down the line. But that's exactly why it's important to see who is more vulnerable to those kinds of risks. And there are a few countries, we highlight, for example, certainly a lot of the frontier emerging markets, along Turkey has some of those vulnerabilities. Brazil, we think, is taking some risks. But there are also a group of emerging markets on the other side, whether it is Israel, Czech Republic, Korea, Thailand, where we don't see those risks as being very high.